Hello. In this video, we'll be talking about stock options, graded vesting, and performance or market-based conditions. Let's go over what a stock option plan is. It is one form of a share-based compensation, and in this situation, a stock option gives the recipient the right to purchase a share for a fixed price for a specified period of time. So if an employee receives options, and on the grant date, the market value of that company's stock is $10. This will likely be their what's called the exercise price, which is referred to as the fixed price in this bullet point. And once they vest into their options, then they have the right to buy shares at $10, and then they can turn around and sell them for, assuming the market price went up, then they would buy shares at $10, sell it at $30, and make a $20 per share profit. So an option is a good way to compensate your employees. However, there is a risk because it only is profitable to the employee to the extent that the market price has increased since the grant date. We, as a corporation, the corporation has to record compensation expense over the service period for which employees receive the options, which is also referred to as their vesting period. Up until this point, if you've watched previous videos about stock options, when a employee works for a certain amount of time, and then at the end of that time, the options become exercisable, they vest in those options. That's called cliff vesting. So if you have an employee, right, and they get hired, they get their options here, and this is year 4, and in year 4 they vest in all the options. That's called cliff vesting, when they vest in one single date. However, more likely, this is what more companies do, is what's called graded vesting, and that's when the recipient becomes eligible to exercise their options over time rather than all at once. So an example might be that a company might award stock options that vest 25% the first year, 25% the second year, and 50% in the third year. So if they got let's call it 100,000 options, then they would vest in 25 of those options in the first year, which means that they could exercise up to 25,000 options because now those options belong to them, and so on and so forth. Another 25,000 in the second year, and the remaining 50,000 in the third year. When this happens, when there's graded vesting, companies oftentimes will use what's called a single fair value, which can be estimated for each tranche of those options, and it's using a single weighted average expected life of the options. And that's a lot of words, but we're going to go into example and you'll see what I mean. And the compensation expense is allocated over the entire vesting period. So let's just go into an example. It'll make more sense. Here, at January 1st, 2027, Torres Mobility issued 10 million executive stock options, permitting executives to buy 10 million shares of stock for $25. So $25, that's going to be their exercise price. When they actually vest in those options, they have the ability to buy the shares at $25. The vesting schedule is 20% the first year, 30% the second year, and 50% the third year. So there's a 3-year vesting timeline. And the value of the options that vest over the 3-year period is estimated at January 1st, 2027, by separating the total award into 3 groups according to the year in which they vest. So let's see what that means. So instead of just taking the 10 million shares and multiplying it by the fair value of the options to equal our total compensation expense, because our total compensation expense is going to be the fair value of all the options. In this situation, when you have graded vesting, you're going to look at the vesting date for each year, right? Each year, the vesting date, how much is vested, and the fair value of each option at each vesting date. Now, the fair value per option, that goes through a very complex option modeling program, and that's not something that you need to know for this class or the CPA exam, but based on the vesting percent and date, the value of the option is different. So if you look at an option pricing model, there's many inputs that go into that, but one of the key inputs is time till the options expire or the expected life of the option. And so the longer the time, the more chance the stock price can increase, and therefore it's more valuable and upside potential. So the value of the option itself is higher as time goes on. So you can see that option increases over time, the value of the option. So let's see how we apply that to our compensation expense per year. First, we're going to do a vesting schedule for each of the years, December 31, 27, 28, 29. We're going to take the number of shares times the vesting percentage for each year, multiplied by the fair value for each per option for each of those years. So here we have compensation costs for 2027 for $7, $12, and $30 for each year subsequent. And now we have to take those costs and allocate it to see how much compensation expense are we going to recognize in each year. And it's not $7 for 2027, $12 for 2028, and $30 for 2029. So please don't make that mistake. Let's start with 2027, right? Our total compensation for 2027 is for 1 year, right? Because it's from 1/1. This is from 1/1/27 to 12/31, so it's for 1 year. It's only for the 2027 year, so we're going to put it under the 2027 column. The next year, we have $12 million of compensation expense related to the options that vest at the end of 2028. Okay, so this is at the end of year 2. So now we have 2 years of vesting going on at this point. So now we have to take that 12 million and allocate it over the 2 years of vesting. So we allocate over 2027 and 2028. The third year, right, is $30 million, and this represents 3 years of vesting now. And now, so we're going to have to take that $30 million and allocate it over the 3 years. So we allocate it evenly. So you divide by 3. And then you have a total for each column. And so for 2027, our compensation expense is $23 million, 2028, $16 million, and 2029, $10 million. So don't forget, this is like when we do graded vesting, the calculation, this is step 1, but now you have to go to step 2. Do not just stop at step 1 and think that these are your compensation costs per year. Let's go through a concept check, very similar to what we just did. On January 1, 2027, a Naylor Sean company had issued 40,000 executive stock options, permitting executives to buy 40,000 shares of stock for $30. The vesting schedule is 20% the first year, 30% second year, and 50% the third year. The fair value of the options is estimated as follows, right? The fair value, you can see once again, per option increases as time goes on. Question is, what is the compensation expense related to the options to be recorded in 2028? So if you want to pause the video and try to figure this out yourself, this would be a good time right now. And if not, then here goes. Okay, so 2027, right? I'm going to take basically the number of shares, the number of options is the same when I'm doing my step 1 in my graded vesting calculation. And I'm going to basically take the number of shares times the vesting percentage per year times the fair value for each year. So that's in this column right here, this arrow. So in 2027, I get 40,000 times 20% times $7 is $56. And that's only for 1 year vesting. So it all goes in the 2027 bucket. 2028, do the same math, and I get $96 of total compensation expense, which I have to split over 2 years because this is my second year of vesting. So I have 2 years worth of vesting embedded in that $96. And same thing for 2029. I get $240 and I'm going to split that over the 3 years. So in total, I have my totals of compensation expense I have to recognize for each year. And for 2028, I have to recognize $128 of compensation expense. Okay, let's go through. So far, we've discussed stock options where the vesting is determined based on the period of time an employee or recipient works at the company. But there can be other sort of conditions attached to a stock option. And sometimes it'll be based on the company performance or market conditions. And based on what those conditions are, will mean that we recognize the compensation expense differently. Okay, so, and when we have options that specify a performance condition or market condition, it's in order to incentivize the employees to work better, be more efficient, so the company can perform better, or the market price will perform better. So an example is that an option might not be exercisable until some sort of performance target is met. And so really the way we account for them depends, is a performance-based condition or is a market-based condition. A performance-based condition is going to be based on internal company performance targets, and they really depend on things the company can actually control or influence. So think of it as they have a revenue target, right? If options will vest if the annual revenue exceeds X dollars, or if they have vesting will be triggered if we have a 20% profit margin, or vesting is determined based on the launch of a new product by a certain date. That's all performance-based and controlled internally. Market-based is all about external control forces, and that's really more for the stock price. The options will vest if the stock price hits X dollars per share, or the options will vest if the stock increases 30% over the next 3 years. It really has to do with market growth. So let's start with performance based conditions, which are the internal things that can be controlled internally. Okay, so when we decide how much compensation expense we're going to recognize when an option is performance-based will depend if it's initially on whether it's probable that the performance target will be met, and then ultimately is the target actually met. So here in the first bullet point, we have to make an estimate, and then we true it up at the end based on what actually happened. Let's go through an example. On January 1, 2027, Universal Communications grants options that permit key executives to acquire 10 million of the company's $1 par common shares. The fair value of the option is $8 per option. The options are only exercisable if sales increase by 10% after 4 years. So this is our revenue increases by X% after 4 years. It is clearly a performance-based condition. And so if we say, yes, it is, the initial expectation is that it is probable that sales will increase by 10% after 4 years. So we say, okay, if it's probable, then we need compensation expense to recognize compensation expense for the full amount of the number of options multiplied by the fair value. So it's 80 million. And what is our vesting period for this 80 million? It tells us it's 4 years. Our sales have to increase by 10% after 4 years. And this entry should look familiar. At the end of each year, we would debit compensation for $20 million because we're going to take the total compensation of 80 divided by the vesting period of 4, and credit paid in capital stock options. That's every single year. Now, That was in December 31, 2027, 2028, we booked those $20 million. Now, after 2 years, the company looked at what's going on and they said, you know what, actually it's not probable that sales will increase by 10% after those 4 years, starting from 1/1/27, right? It's not going to happen. So in that situation, the compensation expense that should have been realized is zero because our number of options expected to vest is zero. So we would have to reverse the $40 million that was expensed in 2027 and 2028. And basically, because this would have been recorded for 2 years, we would debit paid-in capital stock options for 40 million and credit compensation expense for 40 million at the point in time when we realize that it's not probable that we're gonna the sales will increase by 10% after 4 years. Okay, let's take another example. It's the same set of facts, except now the initial, right, we got options granted on January 1, 2027, but they are only exercisable if sales increase by 10% after 4 years. But now in this situation, the initial estimate was that it was not probable that sales would increase by 10%. So there was nothing recorded in the beginning. And then the third year, they switched it and said, yes, it is probable. So in 2027 and 2028, there was zero compensation recorded. Okay. So now in 2029, we say, yes, it is likely, it is probable that sales will increase by 4 years. So what do we do then? Well, we're going to do a catch up in that third year because our total compensation expense for this option grant is 80 million. The probability that we're going to get sales will increase by 10% is 100%. And then now 3 of the 4 years have already passed. We should have already recognized compensation expense for $60 million. How much did we actually record up to this point, up to through 12/31/2029? Nothing, because we thought we were not going to meet that sales expectation. So we're going to report the full $60 million compensation expense, like a catch up, in the year where we say we switched it to that it is probable that those sales will increase by 10%. So we're going to debit compensation expense 60 million, credit paid-in capital stock options 60 million. And then the following year, 12/31/2030, is when we record the final $20 million of compensation expense. Now, that's how we account for stock option plans with performance-based conditions. Now let's talk about plans with market-based conditions. And these are, remember, these are external forces that we as a company cannot control, right? It's based on the changes in the market. And when that happens, compensation is recorded as if there were no target. So you just record the full compensation expense because the fair value estimate of the stock option already implicitly reflects market conditions due to the nature of the option pricing model. So the option pricing model that determines the fair value per option already takes into account market conditions and what the expected market conditions are in the future. So when we have stock options with market conditions, we basically just ignore it and record compensation as if that condition didn't even exist.